Right, hello to you all. This is Adrian here, and it's the Trend Signal podcast, isn't it? And there's a lot we've got to get through today. Sadly, though, for you all, it's just me today, which means you're stuck with my dulcet tones in today's workshop. Jerry's off doing whatever Jerry's doing today, but it's okay, and hopefully you'll be nice and gentle with me on the old questions box there and comments if you're listening to the recording. A lot to get through. Obviously a big week last week. We had the UK general election, and what we're going to do is have a bit of a debrief on that really. We're going to look at the impact on the markets, why the markets had the movements that they have had, which by the way was pretty much in line with expectations. Those of you who've been listening to podcasts from us over the previous few weeks, the impact of the markets, what's happened, you're sure it was a much bigger majority than I think everyone was really expected, but actually the markets have really done probably what we thought they would do with such a result. So we're going to be looking at that. We're going to be looking at what to look out for the week ahead, what we're trading at the moment, and we're also in our defining trading section, we're going to look at something called short covering, and that's relevant when we think about pound dollar, which we're going to be looking at shortly enough, and the movement that we've been seeing there as well. And in terms of the problem with trading, what we're going to do in that section is we're going to take a look at boredom trading. So people trading when they're bored just to be in the market. So there's quite a bit we're going to get through. Remember, the benefit of being 16th of December 2019 is that you can contribute, you can ask questions, you can respond to questions that I ask, and that is a benefit very much of attending if you're in the GoToWebinar login, which a number of you are right now, guys. So, well, look, let's get into it. So what do we know? Well, this is the section where we have a look at what's been happening over the last week, what was the market movement, well, I guess how could we have known about it beforehand is probably a relevant part. Now, usually what I do is pass over to Jerry now to go through these details, but as I said, he's not here today. So, like I said, you are very much stuck with me. What happened? Well, there was a little thing called the UK election. This is not a political podcast, so we're going to get into the markets in a second, but let's just go through the headlines really. An 80-seat majority for Boris Johnson's Conservative government. And what does that mean for us? Well, the main headline, of course, wasn't it, was to do with getting Brexit done, and that's the thing that's had the biggest impact on the markets. We've seen massive moves on the pound, massive moves on the stock market, continued movement on the stock market today. We're going to get into that in a second. And actually, I think it wasn't it written the poorest performance for a Labour party since 1935. We'll talk about that. So I think that's an important point, really. So why is it that they did so badly? What you should probably have a look at is a fascinating article that I read on the BBC website there, which is really talking about the US presidential election and whether they can learn anything on the other side of the pond to do with what's happened here in the UK. So what are the reasons why Labour did so badly? Is it the leadership? Is it anti-Semitism? Is it the far left policies? Is it an unclear Brexit policy? Is it all of the above? Is it other factors? You know, certainly McDonnell was very much talking about it being to do with the Brexit vote, but actually I think if you really read between the lines, it seems to be a little bit more down to far left policies and maybe just a lack of trust in those policies and in the leadership. But you know what? You know, we'll see. The reason I reference the US presidential election article on the BBC website, in fact, I'll just bring it up very quickly, just so you can have a look, just to remind myself of the title of it for anyone who's not able to see what I'm referring to. So something like this. If you search on the BBC News website, will the UK provide a light bulb moment for the US Democrats? So it's interesting because this article's arguing that potentially about sort of more radical socialist far left policies than anything else, people not trusting them. Otherwise, how is it possible that major Labour heartlands could have fallen to the Conservatives? As I say, it's a very fascinating article, and when you think about the main event for next year probably being the US presidential election, does that mean when you've got, well, you're going to be up against Trump, aren't you? You need a Democratic, that's the more socialist side of it really, the Democratic candidate Are they going to be going for someone on the far left, someone like Bernie Sanders, someone like Elizabeth Warren? Are they going to go someone a bit more central? And is the result of the the UK election, is that going to have an impact on who they eventually choose to be the Democratic nominee or candidate, and really Trump's main opponent? It's interesting, actually. And in fact, I sort of won't give too much away, but if you sort of read through this article, it will tell you a little bit about that. In fact, and it's interesting because actually, if you look at the sort of the Labour leaders over the last however many generations, there is definitely usually quite a left-leaning side of it, and yet probably the most successful Labour leader, like him, loathe him, was probably Tony Blair. In fact, he's the only Labour leader that's won 3 consecutive general elections. Why? Because he's down the more central side of policy, and yet, funnily enough, if you think about the way in which Labour leaderships are nominated, what's it? I can't remember. Was it the National Something Committee, National Elective Committee? I can't remember what it's called now. There's a heavy trade union vote, isn't there? So votes are normally dominated by trade unions. So it tends to be whoever the trade unions want to be the leader that tends to be the leader of the Labour Party. And because of that, they tend to be more leftward leaning. Ed Miliband, Kinnock, Corbyn, etc. In fact, funnily enough, when Corbyn was originally put together as a nominee, he was only really nominated as a potential leader, just for a bit of balance over the choice of Labour candidates. And then, of course, the trade unions very much got behind him, just like they did with Ed Miliband, much more leftward than perhaps some of the other potential leaders. It does make one wonder what type of candidate Labour might choose to be the leader of their party going forward. Maybe it's going to be someone a little bit more central, a Keir Starmer perhaps, who knows. But certainly it's going to be, well, who knows, but potentially another 5 years before we do find out. But I think, talking about the big sort of impact, it could be an interesting thing with the US presidential election. I'm going to move on from politics now, Michael. It was an interesting article. I wanted to bring its attention because actually I think this has got a big impact on the markets for this coming next year, because the US presidential election is going to be something that's going to dominate the movement on the markets for next year. That's why I'm bringing it up and going into a little bit of detail there. Is it going to be Trump? Is it going to be somebody else? The argument from this article could well be that if it's someone on the far left, then Trump will rump it. If it's not someone more central, then maybe it's going to be a bit of a closer fight, and that could be a bit more interesting perhaps for the markets. We shall see. So look, as for the markets, we talked about the movement, or the likely movement, sort of pound dollar. Big rally, of course, at the end of last week. Goldman Sachs had put out an original target at 132. That was achieved on, Tuesday. We hit the 132 target there. And so it's kind of hit that level, held that level then for the next few days until a big rally there on Friday on the pound, or really Friday, sort of Thursday, just as soon as the exit poll came out, really, wasn't it? Why was that? Why did the pound have such a big rally? Well, it's to do really with, why is the market going to rise? It's going to rise because of buying. So effectively, buyers prepared to pay higher prices, and that's going to be down to 2 things. Number one, it's going to down to buying, or it's going to be down to closing out of selling trades. So new buying or closing out of sell trades, short trades. This is what we call short covering. We're going to talk about short covering a little bit later on, everybody there, and what actually short covering is when we talk about the defining trading section. But effectively, if you think about the movement in the pound ever since the Brexit vote came in 2016, the pound has been moving down quite dramatically. A lot of shorting, hedging, strategic short hedging from institutions. They've lifted those effectively now. They're lifting a lot of those hedges. They're covering a lot of those short hedges, which means they're buying the market back up again to close those trades. It may not necessarily be fresh buying, it's potentially more about closing short hedges. Do you see? Anyway, certainly a big move up. What does that mean going forward? Well, we can talk about that a little bit later on maybe, but certainly in terms of the whole getting Brexit done, what does that mean? I think that means that actually we'll see the shackles come off foreign exchange. Foreign exchange has been on relatively low volatility for a while, and not really much interest in carry trading because certainly, if anything, interest rates have become lower over the last 12 months there with 3 rate cuts in the US, which has made foreign exchange volatility contracting. Really, actually, I think one thing that we're going to find with this, with the Conservative majority, with the more likely to move on beyond Brexit and beyond that stalemate, so I think we're going to get a lot more capital inflows and capital outflows of the pound. What that's likely to mean is more movement, bigger trends, and bigger potential opportunities for traders. Now, if you look down on the bottom right-hand side, I'm sort of jumping the gun from what we should be trading section, really, but you know, the monthly trend turned up. You see, bottom right-hand side of my chart, we turned up. We had a buying opportunity at the end of November for the pound-dollar monthly. That's carried on. All other things being equal, we would expect that trend to carry on there, you know, potentially target around about that sort of 140 level, looking back to that pivot point back from the sort of early part of 2018, so sucking up towards that potential level. And similarly, someone asked about euro sterling or pound euro, similar sort of thing. We had the euro pound trend turned down, so effectively we can expect, or at least it seems like, uptrends now that this is done, now this is out the way, everyone can start to move on with their lives. You should start to see perhaps a bit more of a rally in the pound there, maybe even some potential takeovers that people are talking about as potential sort of aggressive, hostile takeovers in the stock markets of UK companies. But we'll see with that, because actually UK stocks are relatively undervalued compared to overseas peers there. So be interesting to, fascinating to see with the pound. It certainly seems strong at the moment, and really with the uptrend there, I think we can really look to see that 140, as I said, 140 price target, about 140.30 there on pound dollar. In terms of the stock market, well, let's have a quick look at the stock market. We saw just coming into it on Thursday night there, we had a buying opportunity there for the UK 100, their lovely buy trade from Thursday night. Bit aggressive, maybe taking it on the vote there, but I think really the more potential risk, the more potential dangerous movement was really to do with the pound, really more potential flux on the pound, depending on the result, much less so on the UK 100 buy there on Thursday night. Market rallying quite nicely there. It's quite an interesting though one, because actually ordinarily when you see the pound rise, you would typically see the UK stock market fall, or the FTSE 100 fall. Anyone know why that is? Why would we normally see the UK FTSE 100 fall when the pound rises? Anyone know? It's basically down to the fact that actually the FTSE 100 is not a barometer of the UK. That's more the FTSE 250. The FTSE 100 is predominantly global companies, and they're global companies with a lot of overseas revenue, so exports and so on. So a higher pound makes their exports less competitive, and it affects their profits basically. Either way, a higher pound is generally not good for the global companies that tend to be in the FTSE 100. And in fact, we actually saw that over the, in terms of the individual stocks. We saw the FTSE 100 on Friday rally about 120 points, and it's carried on to a similar tune today, hasn't it? We've seen that. But actually, the movers, if you look at what the real movers were on Friday, they weren't your BPs, they weren't your Shells, the big global companies there. Those are the ones that actually fell on Friday, even though the UK stock market was up over 100 points. The reason that for the driving force was, you know, companies like your house builders, your UK companies that could actually, again, maybe arguably shackles are off, and actually we can start to get things done. It was more of a certainty play, I think, probably there. Okay, so house builders, very, very strong. UK companies, effectively, very strong. Global companies, less so. And that makes sense when you consider it in terms of their exports and consider that impact on their earnings. So FTSE went up, like I said, about 1.5% overall. Yeah, with Shell and BP down, effectively, two of the biggest, 4 or 5 companies in the FTSE 100 actually down. It's quite a remarkable move, actually, if you think about it. What else last week? US stocks. I mean, US stocks went on to a new all-time high there. You can see the S&P is unfortunately very annoying not to get on this buy back from or movement up from the 10th of October, not quite meeting the rules of a continuation trade, which is frustrating. However, of course, we were still in buy trades on the DAX and the FTSE, so we made a bit of money on that rally there. So why was the US stock market going up? It's all down to the trade deal, really, down to the China has been postponing extra tariffs on the US cars and other goods after it completed phase 1 of its trade deal last week. So that was quite positive. So the US markets, S&P rallied to new highs there. So big week actually last week, as it turned out. Like I said, I personally believe that what we're going to see here is with us being able to move on instead of kicking the can down the road, which we've been doing for the last sort of year or so. Now we can hopefully move on, get it all done, whether you believe in Brexit, whether you don't believe in Brexit. This is apolitical, really. What this is about in terms of the market, we should start to see more movement, more confidence, more certainty, and therefore more speculation and more opportunity in the markets, which I'm very much looking forward to, I must say, and what has been quite a low volatility 2019. Okay, so what don't we know yet? Well, here we're going to have a quick look at the economic calendar for the week ahead. Actually relatively quiet as we sort of start to wind down a little bit to the Christmas period. You can see the economic calendar on screen. You can go to Forex Factory, plenty of other ones around, the high impact red items there. We've already had a little bit out for today. Flash manufacturing, flash services in Germany and the UK, both of which lower than expectations there. So effectively, when you look at the PMI data, Purchasing Managers Index, this is basically down to a number of 50. When the number's at 50, that means that it's gone nowhere. But effectively, if the number's higher than 50, it means that it's expanding. You know, there's increase in spending and so on. And when it's below 50, it means it's contracting. Okay, so what you're basically looking at there here, we're expecting in Germany flash manufacturing PMI at 44.6. It came in worse than that at 43.4, so it's contracting more than expected, the manufacturing sector in Germany and in the UK as well. We're expecting a small minor contraction of 49.1 for manufacturing, 49.6 for services. Again, both coming in contracting higher than expected, perhaps down to uncertainty over the UK election. People just sitting on their hands a little bit, waiting for the vote. I think actually next month will be perhaps a little bit more interesting. We'll see. But certainly, you know, when you look at the graph of German manufacturing PMI, yeah, perhaps it's holding steady, its contraction at the moment, but we'll see. It just goes to show just how much it's been struggling. Look at the growth that we're having in the beginning part of 2018 over in Germany, and really has come back some way. So a little bit of movement there. Eyes will very much be on this 245 data from flash manufacturing in the US, 52.6. And I think this actually really demonstrates a little bit about the difference there. They're expecting that expansion there, whereas over in the Eurozone, it's very much been about contraction instead. So sort of polar opposites in many ways. What don't we also know yet? Like I said, it is relatively quiet. If I think now through to Thursday. Oh, by the way, before I get into it, interestingly enough, one of the things we see, when you see that number there, like 47.4 for flash manufacturing PMI in the UK at 9:30, really what that should effectively say is the UK economy is struggling. If the UK economy is struggling, signaling the next interest rate move is more likely to be down than it was before. What should that mean for the pound? It should mean that the pound would fall, okay? But however, we've actually seen the pound rise, probably more based on the fact of the post-election move that we're up sort of, 30 pips or so, at least we were about half an hour ago, rather than anything to do with this data. So maybe discounting this data a little bit on the basis there is in context, yes, it's fallen, yes, it's contracted more than expected. However, with the election there, maybe people not wanting to make decisions over that basis of uncertainty. So maybe there's a little bit of an asterisk or a caveat attached to that, which is why the pound is actually up a bit today. So the pound, yeah, it's up 35 or so today there. Now, in terms of other data for the week ahead, Thursday, we've got a couple of bits there. The most relevant probably being MPC in the UK. So that's when we're looking at the votes. That's like the minutes, the summary after the actual vote itself a week or two ago. You can see that in the last MPC meeting, the Monetary Policy Committee, when they set interest rates and monetary policy, there was a 0 vote for a rise, 2 votes for a fall, and 7 for no to remain unchanged. So it's really going to be about what they say on Thursday. This often has a bit of an impact on the currency markets in particular. And I believe, maybe we've got one more actually. I think Mark Carney is as the governor of the Bank of England. I think he's probably got one more. He retires on the 31st of January. Interesting to see who comes in. I don't know if we already got someone lined up. I'm not too sure really, but it could mean to a slightly different policy in terms of monetary policy there. But really not a lot this week. We're very much winding down into the Christmas period. In fact, for next week, oh my word, it's going to be dull. Look at that. Look at all those bank holidays for next week. Very, very limited amounts of data coming out there. Okay, so what should we be trading for this week? Well, let's talk about volatility for a second. As I said, I personally believe that we're going to get more movement in the year to come than we have done this year. Whilst I would certainly prefer a lot more disparity, a lot more difference between interest rates between different central banks, because of the carry trade, that's probably not going to happen. However, like I said, I think with this happening now, there's more certainty on the global economy, maybe even perhaps more certainty to do with the China-US trade deal. I think we'll start to see a little bit more movement, some bigger trends, some more opportunity on those foreign exchange markets. So whilst I may not be trading the pound in the immediate aftermath of the election from last week, certainly I am looking for buying opportunities. So we're looking at probably smaller dips, looking for bigger opportunities on the buy side for now, at least anyway. Of course, those longer term monthly trends can change. What we're looking at is these arrows here. When you put my cursor over here, you can see that the weekly trend at the moment is up with the green arrow on the left side. The monthly trend is up as well on the pound dollar right now. Would that carry on? Look, the point really being is that we shall look for shallow pullbacks followed by hopefully bigger moves to the upside. What that means economically, I'm not too bothered about really. I'm just interested from a trading perspective. The trends would suggest that the path of least resistance now is to the upside, and so potentially looking for bigger moves. And already in the last couple of months, we're seeing bigger moves than we saw really for the whole of 2019, where we were very much stuck, and hopefully we can see it, like I said, pushing towards that 140 level over the next couple of months there. As for US stocks, well, like I said earlier, we're still looking for US stocks in terms of opportunities to sell. We have that selling opportunity there, relatively short-lived, certainly quite big though, notwithstanding about 400 points as a fall, big crash there. But of course, it's firmed up a little bit as those US trade, China trade talks have come through there. You're looking at this returning to those highs. The Dow not quite as strong as the S&Ps. The Dow is only 30 stocks, remember, and the 30 stocks selected by a particular panel. So it's not even the biggest 30 stocks in the US, but certainly it has made a new all-time high on Friday. S&Ps much more prominent to the upside, continuing to move to all-time highs. What does this mean? It's always interesting when you see a market that's going for new all-time highs. It's going to new all-time highs for a reason. People are buying it, they're not selling it at the moment. So what does it mean for us in terms of opportunities? It means buy the dips. Sure, it means that. But it's always that temptation, everybody, to look for just to sell it, just to short it, just because it's expensive. You know, you look at client sentiment out there, people who are trading the S&Ps, trading the equity markets, people will be overwhelmingly short right now. Probably at 80% of traders are probably short the US indices right now. Why? Because it's expensive and people think something called gravity exists in the markets. It doesn't really. This market could overshoot. What could drive it down? What could be the shock thing that drives the US stock market down? Well, we don't know because it's likely to be a shock. But there's one thing that I think is worth bringing up there, is that now that phase one is arguably complete, okay, he's going to move on to phase two. I don't know how long that's likely to take. But is that a reason to take profits now? If you think about the big rise in the stock market, generally what I find is that markets top out based on good news, because once you've got that good news confirmed, often it's the case that there's, well, that's it now. What other good news could there be? What you're left with then is done. Okay, that's why I was in it. It's hit that news. I'll take my profits, thanks, because next I've got potential uncertainty. Who knows what can happen after that? So often it is good news that tips out a market. Am I saying that's going to happen right now? I don't know, really. But what I am going to do is look for those turning points in the markets there. Like the sniper disc here, looking for the lines changing color and so on. My eyes will be very sharply focused on those US stock indices over the next couple of weeks. Statistically, Christmas period is a tough time to short sell stocks. So it may well be that we don't have shorting opportunities over the next week to 10 days, but I will very certainly be looking at the stock market, the US stock market in particular, to look for opportunities of turning points and opportunities of short selling on those markets and profit taking on the US stock market there. So keep an eye on that. One thing I do want to say, guys, is don't just sell it because it's expensive. That's a pretty dangerous thing to do. Look for your selling opportunities. Look for your turning points. Look for your criteria that makes it a good trading decision. Don't just sell it just because the market's gone up a lot, okay? That would be a pretty dangerous thing to do. Okay, so we're kind of jumping around a little bit really today, I would say. So what I'm going to do is have a quick look now at defining trading. The thing I wanted to talk about was short covering. Do we all know what short covering means, everybody? Maybe you can pop me a message into the questions box. Ultimately, short covering is effectively the closing of short trades. Do we know what short selling is? Short selling is speculating on prices falling. So effectively, you've probably heard of the concepts of going long and going short. Going long is when you own something, so you're long of it and you're expecting that price to then rise. When you're shorting it, means effectively you're selling something that you don't even own. In fact, you're short it, you don't have it. So you're short of it, basically. So basically, when you expect prices to go up, you will go long, you will buy that market and go long. When you think prices are going to go down, you will short sell. Okay, so you're going to sell it with a view to then buying it back later on. I won't get into the details of what it all means in the background of that, but basically what's going to drive a market is effectively, of course, buying or selling, or people prepared to buy at higher prices or people prepared to sell at lower prices. And you're going to get two types of buying or two types of selling. Of course, you've got speculation and hedging, but what I mean by that is you've got new trades, buying of new positions, or you've got closing out of short positions. So they're both buy orders, you understand. But when we talk about the pound rising last week and a heavy rise into the last couple of weeks, in fact, why don't we quickly look at the chart? You can bring up your own pound dollar charts just to see that really we had a big rise really in the few weeks into the vote, and really for the last 2 or 3 months, big rises in the pound. Arguably, a lot of comments have been, a lot of that's down to short covering. So who was short? Big institutions were short as a strategic short hedge against Brexit. So a shorting, speculating on the pound falling to protect, not really it's a hedge, it's not speculation, to protect their positions. So what basically that means is, as that moves into a period where there's uncertainty again, they're going to start to maybe, or risk of it carrying on, a risk of Brexit being finished off, effectively a lot of those short positions were arguably being closed out. That's buying. That's not necessarily new buying. I'm sure there was an element of new buying of the pound, but there was also a lot of closing of big banks, of pension funds, hedge funds, closing out their strategic short positions to buying those positions to close. Okay, so that's what we call short covering, closing your short trades. Does that make better sense? Okay, so how can you spot that it's short covering? Well, one thing that I always think about, I'm not sure there's any really definition from this, but sometimes you can see this with a lot of big moves during the day. So very often what you'll find is you have a big move on the day. If covering, it usually means that it carries on into the close. And let's think about this for a second. If you get a big move up on the day, okay, and you are long and the market rallies, what are you most likely to do before that market closes out for the day? You're probably going to close that trade and take your profit, aren't you? So what you can often see if it's new buying is that you're going to often see the price rally. I'm not looking at a chart adder. You're obviously going to see the price rally. You're then going to close it out, and then the price, and if everyone's doing that, you're going to see the price then ease back. So you can see a little bit of a spike on that daily bar. Often if it's short covering, you can often see a good big move into the close, because there's no profit taking to be had because people are already closing the trades in the first place. So what you'll often find is when it's short covering, or in fact actually stop losses triggering, i.e. closing out of trades, you'll often see the market close at its highs or close at its lows, rather than if it's new speculation coming through on that day, you'll often see those spikes coming through with the market effectively closing those trades out. Hopefully that makes a little bit of sense there. Just think about it in terms of profit taking. If you're closing your trades and you already closed it, so there's nothing to take profit by into the close of the session, to the end of the session. So a little bit about short covering there. The next thing I want to talk about, and the final bit for today's session, is in the what's the problem section. We take a look at a particular problem that traders face, and we're going to have a look at it. Now, last week, we had a look at trading over announcements. Hopefully that was helpful. Today, I'm going to look at boredom trades. And this can be especially relevant to intraday traders. So people are trading within the same day. So buying it and then closing it on the same day. Boredom trading. This is effectively placing trades just because you need something to do. You're bored, you'd rather be in the market than not be in the market, and effectively it's about, well, look, if you have a trading plan or if you don't have a trading plan, it's about the ability to stick to your plan. If you don't have a trading plan, or if you break it, then it can lead to all sorts of problems. Boredom trades is a potential issue, and it's something that a lot of people don't really think about probably. Putting on a trade just for the sake of it, just because you need something to do. You're sitting there, you've got a couple of hours to trade, nothing's really setting up, so you might as well just shove a trade on just because, well, you know, why not? Rather be in the market. This is actually a really bad thing. You know, what traders need to do is focus on their risk management. They need to focus on their trading plan and being disciplined to that trading plan. And the reason that's important, because if you've got a plan, there's no doubt been a certain amount of reason behind the construction of that plan, right? So you've done it based on fact, based on logic, based on statistics. Placing trades just because you're bored is probably going to break every single rule that you already have. You'll be going against your trading plan, and that indiscipline can be extremely costly. So the problem with boredom trades is shoving trades on that don't meet your rules just because you feel like you need to be in something. And in fact, it's actually a totally irrational thing to do. It's almost like expecting the markets to dance just because you've got a spare half an hour. I would say to you, actually not being in a trade, not being in a position is a position in itself. You choose to go long, you choose to go short, or you choose to do nothing. There is nothing wrong with doing nothing. That is the position. Because if you're not in anything, you're making a decision to say the probabilities are not right at this point. There is nothing leaping out at you to make you to want to make that trade at this point. Successful traders all have a plan. Successful traders all then stick to that plan. What they're not doing is making rash decisions based on emotions or based on being bored, okay? So when you're thinking about trading, It's about finding the best trades according to your plan. It's about having an edge that allows you to make the right decisions. And it isn't actually that hard to do. And in fact, for a lot of traders, what you have to have is that plan in the first place, okay? So you have a look at a trade, you make sure it meets your objectives and your criteria before you place them. If you don't meet those criteria, you just simply don't place that trade. Yes, it can be frustrating, but I want to take a second to think about something called confirmation bias. Confirmation bias. Do we know what confirmation bias is? It's effectively once you've already decided to do something, all you see is that, basically. And when I think about bias, it's a big thing with trading. What I mean by that is that people think about things in different ways and people rationalize things in different ways. If you fancy a trade, but it doesn't quite meet your plan, and you decide to dodge that trade because it doesn't meet your plan, that is generally a good thing, right? Because you're sticking to your trading plan and you are remaining disciplined. Here's the problem, however. In avoiding that trade, what you're likely to do is have a look at it and see what would have happened had you have done that trade, right? You should know you shouldn't have done it, but you're going to have a look at what you should have done, what would have happened had you have done that. Let's say the trade you miss, because it wasn't a trade in the first place, goes on and would have been a winner. It's horribly frustrating, isn't it? Horribly frustrating. What's likely to happen is you're going to put more emotional store in that missed trade being a winner than you would being a loser. What I mean by that is you're more likely to remember a missed winning trade than a missed losing trade. That then increases its level of importance in your mind. So effectively, your mind will be skewed to all those moves that you didn't take that are going to be winners will far outweigh any losing trade that you missed. Okay, it's quite hard to explain this, but effectively, let's say you dodged a trade. You're much more likely to get frustrated and annoyed by it if it went on to be a winner, but you missed it, than missing a trade that went the wrong way because you weren't in it. There's no emotional story in that. It's like, yes, I knew I shouldn't have been in that trade. That's great. What you're likely to be is horribly frustrated by that trade that you didn't take in the first place. What that means is, that sort of bias there is that if you have a much bigger memory of the pain of that trade that you missed, what you're more likely to do is break the rules the next time. Okay, and you're more likely to do it because you put more store in that missed annoying miss of profit. Absolutely, it's human psychology. It's very frustrating. And this is why having a plan is so important, because the next time you're then looking at the markets and you'll see a particular pattern that's coming up, you'll actually be more inclined to take it even though it misses the rules, because you'll remember that trade that you missed that went on and hit target. The problem is you're making that decision based on imperfect information. It could well be that trades that meet that pattern only have, I don't know, a 10% success rate, but you're only remembering it based on that winning trade that you missed, and it's very, very frustrating. What you'll then think, you'll have a bias towards those trades being great, even though it's not true. What you need to do is make sure you look at those trades. Oh, why did I miss that trade again? Do I need to reevaluate my plan? Should I have taken that trade? Is that actually a profitable pattern that I should now be taking? The problem for a lot of traders is they won't do that research. They'll say, oh, I knew I should have taken that. Ah, stupid. Okay, I'll remember it and I'm always going to do those trades. Actually, that trade probably was a really bad trade to take. It just so happened by luck that actually went on to be a profitable one. The fact of the matter is, unless you actually know, do the analysis and do the homework, you won't know whether that's a particular good strategy or whether the only reason you want to take it is because of a bias in your view, confirmation bias in what you want to do. Does this all make sense? Hopefully, it's actually quite a difficult thing. I'm not a psychologist. It's quite a difficult thing really to explain. I think the point really being is this. Unless you're able to analyze these things properly, unless you're able to look at the statistics, go back through the charts and look to see if that particular pattern is a good pattern, then you shouldn't make your decisions based on one particular move or one particular trade that you've missed. You need to confirm to yourself that it is a profitable pattern, that it is a profitable setup. The statistics don't lie. Check the statistics. Don't just do it based on one particular trade, or just because some guy tells you something down the pub that that's a cool thing to do. Go back through the chart, check that it meets your rules, and if it doesn't meet your rules, don't trade it. Evaluate it afterwards and then see if you need to tweak your rules. But in tweaking your rules, in tweaking your trading plan, make sure you go through the charts, put the work into it to make sure that it is the right thing to do. Otherwise, like I said, you're much more likely to make emotional-based decisions. And if you think about that, getting angry about a trade that you avoided, missed, and so on, that goes on to be a winner, that's an emotional play, that's psychology, that's emotions, rather than trading something based on probabilities and logic, okay? Trading should be based on probability and logic. It should not be based on emotions. The more emotional you are with your trading, frankly, the more likely it is that you're going to mess it up, okay? And that's generally the biggest problem that a lot of people have, trading on emotions rather than logic, statistics, facts, and so on, okay? Hopefully that's useful, guys. Now look, if you are interested in a plan, then what I can do is just simply direct you to a live event that we'll be running this week, where we'll be teaching you our sniper trading strategy. If you'd like to come along, you can go to the webpage you can see online, but I'll read it out now anyway if you're listening to us on SoundCloud, or if you're listening to us on anything else, audio podcast, bit.ly, bit.ly/learnts. You can go there and you can register a place on one of our live events where we'll go through effectively step one for building a trading plan and learning 3 simple rules to help identify some turning points in the market. Now, Ian's asking me a quick question before I do move on to do with pound Aussie. To be honest with you, I'm not actually trading. Okay, I'm not actually trading the pound right now. So I'm holding off on sterling trades. Okay, so we can have a look at pound Aussie, but I haven't traded sterling trades, certainly on daily charts, for a few days now. There's no, just so you know, Ian, there'll not be a buy continuation on pound Aussie because the way in which the vector averaging trades there. So you can see the erratic nature. What I'm hoping is more decision, more stronger trends that we'll find. It's effectively an uptrend right now on pound Aussie, and we are favoring the buy side. Hence, the continued move to higher highs and higher lows. It seems like, with the trend as it is, that will look to continue. But I'm holding off on sterling trades. I'll let this market settle down for a few more days and probably start trading them in the new year, guys, okay? I'm not interested in gambling. I'm interested in trading probability and logic, guys, like I said. And then finally, one more thing, everybody, in terms of tuning in to the podcast, if you want to tune in after the live events, we may not be continuing with the live ones in the new year. You can find them in a number of ways. Number one, you can go to trend-signal.com/trendsignal-blog, which is a bit of a mouthful. So trend-signal.com/trendsignal-blog, or you can watch them, search for the Trend Signal podcast, and you can search for it on Apple iTunes, SoundCloud, Spotify, and also on YouTube as well, guys. So you can listen to it, you can watch it live, or you can watch it on a recording, whatever works for you. So guys, I'm going to call it an end to my bit. Hopefully I wasn't too stale for you today, and you've kept awake during this podcast. We'll be back. We will be doing a session next Monday. I don't know if it's going to be live or recorded, but we'll let you guys know, certainly. Guys, have a great week's trading, and all the best, and bye-bye for now.